What property valuation insights help optimal investment decisions? Imagine walking into a property and knowing exactly what it's worth and how much it could grow. That's what understanding property valuation gives you. It's like having a clear map before starting a journey. When you know the true value of a property, you can make smarter choices about buying, selling, or improving it. This helps you avoid overpaying and ensures you get the best return on your investment. One key way to value a property is the sales comparison approach. This method looks at similar properties nearby that have recently sold. If a two-bedroom apartment sold for $50,000 last month, and yours is similar, that gives you a good idea of what yours might be worth. Adjustments are made if your property has a better view or is newer. This approach is especially useful for residential properties in active markets. Another method is the cost approach. Here, you calculate how much it would cost to rebuild the property today. You subtract depreciation for wear and tear, then add the land value. For example, if building a similar property costs $50,000 and the land is worth $20,000, that's your estimate. This is helpful for unique or new properties where comparable sales are hard to find. The income capitalization approach is vital for rental properties. It looks at how much income the property can generate. If a building earns $10,000 a year after expenses, and the capitalization rate is 5%, the property's value is about $200,000. This method helps investors see if the property will produce enough cash flow to justify the purchase. Price per square foot is a quick way to estimate value by dividing the price by the total square footage. If a property costs $100,000 and is 1,000 square feet, the price per square foot is $100. This helps compare properties quickly but isn't as precise as other methods. Market analysis tools like comparative market analysis or automated valuation models also play a role. A comparative market analysis compares recent sales and adjusts for differences. Automated models use algorithms to estimate value based on large datasets. These tools speed up the process but should be checked with local market knowledge. Location factors are just as important. Geographic information systems help analyze proximity to transit, schools, and employment centers, which influence property desirability. Tracking occupancy rates, rent growth, and supply and demand ratios helps identify areas with growth potential. Using these valuation insights, you can decide whether a property is a good investment. For rental properties, focus on income potential and operating costs. When considering buying, look at recent sales and market trends. For unique properties, the cost approach gives a realistic value. Combining market data and location analysis helps you spot growth areas and make smarter decisions. By understanding these property valuation methods and market tools, you can confidently evaluate properties. This knowledge supports making investments that balance cost, income, and market conditions. It's all about making smarter choices to grow your urban property portfolio.